Hey guys, welcome back to another video. In this video, I've been talking about this for a long time. It's part of our educational series, but I felt that it's been a while since I have chatted about this, and so I wanted to do a video for you folks to go through what we call the financial distributors. And I think this is very important because we're coming across a lot of decisions that have been made over the last few years that affect us. And I don't think we quite understand, we meaning the general public, quite understand what these decisions mean to the things that we have to try to build our wealth and save for retirement and all those buzzwords and things that we hear about. And so I figured I'd do a video, a recent up-to-date video, talking about what we call financial distributors. Now, if you're not a subscriber to this channel, go ahead and hit the subscribe button, hit the little bell, so you get notified when we do other updates. Now, our focus and our goal on this channel is to focus on, as an asset coach and tax strategist, are the economic termites. You can see my book back here called Economic Termites, and it talks about taxes, inflation, time, laws and regulations, and debt. And the focus here is to address these issues for you and I as business owners. And what does it mean? In some of the articles that we go through, if you look at some of our other videos, we go through the articles and we try to dissect what are they actually telling us or not telling us, which is most of the time the occasion of the situation. And so these decisions, they affect us. Now, out of all these termites, out of the 5 termites, the most detrimental is laws and regulations, our politicians. And it's not a knock on politics, it's just knock on the decisions that they make. A lot of times affect the economy and affect situations a lot of times in a negative, adverse way than they originally planned for these laws and regulations that they pass. So that's what happens with capitalism and free markets. It's like a flowing water. It's going to go the path of least resistance. And that's what the free markets and capitalism does. And so what I'm going to go ahead and do is I'm going to go ahead and share my screen. We're going to go through a PowerPoint presentation that describes these financial distributors. I'm kind of going to walk through some of this stuff, and I'm going to have my video down on the little bottom here so you can see me or I can see you. And let's kind of go through here. So I'm an asset coach and a tax strategist. My company is Terra Firma Business and Financial Consultants, and this is really part of our educational series we called Farming Assets. So let's dive into this a little bit more and talk about the financial distributors. What are those? Well, what is a financial distributor? It's very simple. It's a company or an institution that offers financial products. Very, very simple. Now, here's what we want to know is, who are these financial distributors? Well, there's 3 of them. There's banks, investment companies, and insurance companies. Now, what's the purpose of each of these financial distributors? Well, banks represent leverage, right? We use banks to buy our home, cars. We use them for credit cards, for business loans. Banks are there to design leverage, give us access to liquidity or give us access to funds. The Federal Reserve is what controls the banks, and the Federal Reserve printing money or raising or lowering interest rates is what affects the liquidity, meaning how much money goes to the banks that the banks can distribute to you and I as consumers. That money, the access to those funds and the cost of those funds is what allows us as consumers to dictate, is this a good business decision? Is this interest rate and this amount of money that I can get from my business, is this fair? Can I generate enough revenue? Can I generate enough from this loan and the purpose of why I'm borrowing this money to pay for the cost of this money? That's the key. The other thing is, with investment companies, represent risk. Investment companies and banks are included in this, where they help companies go public, or they help companies borrow money in the form of bonds, or municipalities in the form of municipal bonds. Investment companies represent poolings of assets like mutual funds. So that's what we're going to focus on here, but it all represents risk. Now, insurance companies represent safety. The whole reason why you have insurance, whatever kind of policy you have, whether it's home and auto, it's to reimburse you financially for a loss of that covered risk, right? So we'll kind of dive into this, and this is how these 3 represent. All right. So first, we want to talk about, what is an asset? And I hate to be that basic, but we need to understand the basics of what is an asset to understand what these financial distributors provide to us as consumers, as business owners. So an asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. Okay, so the key here is future benefit and economic value. Okay, those are important. Assets are reported on a company's balance sheet and are bought or created to increase a firm's value or benefit of the firm's operations. Okay, another important thing. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, or improve sales. So this is important. This is why we talk about this. It's to understand the case and the issue of what an asset is. It's very simple. So if we know what an asset is, let's talk about what is a liability. Well, a liability is something that a person or a company owes. Usually it's a sum of money. Okay. Now, liabilities are settled over time through a transfer of economic benefits, including money, goods, or services. All right. Now, recorded on the right side of the balance sheet are liabilities, which includes loans, accounts payable. This is important to know. Deferred revenue, mortgages, bonds, warranties, or accrued expenses. Those are all examples of what liabilities could be. Okay. All right, so now let's dive into banks, equal leverage. What's that mean? Well, the reserve, I had mentioned Federal Reserve earlier. The Federal Reserve gives us the ability to have access to funds. Now, before, you can see in here the effective date, January 18th, 2018, you see this net transaction account. Okay, and so they would break it down that if there was a bank that had 0 to 16 million, they didn't have to hold any liabilities, meaning for a bank, what is a liability? Accounts payable. Remember, that was a liability on the previous, what is a liability? Banks, how do they make their money? By lending this money out, right? Lending it out. Credit cards, home loans, whatever, and they charge a interest. That interest is their rate of return. Now, what do? Well, they get money from the Federal Reserve, but also from you and I as depositors. When we take our cash and we deposit it in the bank, this is why CDs at the bank are so important, because we take our cash and we plop our cash in the bank. The bank can, from 0 to 16 million, say, okay, Mr. and Mrs. Client, you have $100,000 in your savings account. What the bank will do is they'll lend out $100,000 and charge interest. Now, it's a notation. Your statement in your account still going to show $100,000, but they leverage that using the liquidity from the Federal Reserve, the money, to make money. Okay. Now, between 16 and 122 million, it's 3%, and over 122 million, it's 10%. Okay. Liability, meaning what they have to hold. So they have to hold. So what's that mean? Well, this is important because when we're looking at this 10%, how does a bank make money? Like we said, they lend out money and they earn interest rate. Lending equals leverage. Leverage equals lending. Now, when we look at this 10%, that means 90% of the money can be leveraged. 90% of the funds that they have in house can be sent out in the form of loans, okay, to where they can make money. Now, here's the interesting part about this. Remember, laws and regulations, when things change, what happens? Well, things change. So what happened in March 2020? Okay. COVID. The government shut down. Look what happened at the Federal Reserve. That same day that the country shut down, March 15th, the Federal Reserve announced on March 15th, 2020, the board reduced reserve requirement ratios to 0% effective March 26th. Okay, this action eliminated reserve requirements for all depository institutions. So immediately, what the Federal Reserve said, you don't have to have any cash on hand as a liability, just in case, knock on wood, something happens. You can take all the cash that you have, all deposits, and lend it all out to generate a rate of return for a bank. Okay? Now, remember, this is all after 2008, so 2008, after the financial crisis. They had quantitative easing. They took all the bad mortgages. They created TARP, and they created all these little entities to put all this bad stuff in the kind of this box, put it in the closet, close the closet, don't look at it. Can't go in there. That room you're not allowed to go into, okay? Now, since quantitative easing, since printing, and now this started what? This started the actual printing of more cash, and which is why we're in this inflationary period now today. This is why I when you see me talk about inflation and the Federal Reserve saying transitory and using these buzzwords and these terms, why I called BS. Because this day they knew that they were going to have to change it. You cannot be in that position and not understand the basics of economics. When you flood the market with cash, it's going to create inflation. When you change interest rates to be cheap to zero or close to zero, it's going to create liquidity. It's going to create inflation. That's the basics of economics. So for them to say this is transitory and use these terminologies to try to make us think like, oh, this is going to just be temporary, it's going to be fixed. BS. Okay, that's wrong. And this is why. Because look what happened. Let me move my picture here. Look what happened. So in 2020, this is what we're talking about, all net transaction accounts. So remember, before this decision, there were 3 transactional periods of accounts. Up to 16 million was 0, up to 16 million to 122 was 3%, and 122 plus was 10%. Now, all net transaction, all at 0. Okay? So that's pretty important to understand. Now, does this mean that this is a bad thing? No, you just need to know the rules. You need to understand how the system's designed, because as business owners, we need banks, we need to leverage. And in fact, in our planning strategies, we love the term, the use of leverage, because it protects your asset, but it also allows you to grow assets if your plan's correct. So I'm not saying this is a bad thing, but this is just a rule in how the system is designed that we need to understand and focus on. Okay, now, investment companies represent risk. An investment company is a corporation or trust engaged in the business of investing the pooled capital, of investors in financial securities, okay? So if we were to dive into what financial securities would be, it would be equities. So stocks, bonds, those are financial securities. Now, in most, this is most often done either through a closed-end fund or open-end fund. What they're referring to is mutual funds, okay? In the United States, most investment companies are registered and regulated by the Securities and Exchange Commission, the SEC, under the Investment Company Act of 1940. So this has been around for a long time, okay? This is not new. Now, an investment company is also known as a fund company or fund sponsor. And remember, what this does is mutual. It pools capital, so your investments, pulls it together. Okay, they often partner with third-party distributors to sell mutual funds. So in third-party companies such as Fidelity, Vanguard, right? American Funds, and you can go down all this list of all these other companies that provide us, okay? All right, this is risk. Why is this risk? Why are we saying this? Well, because what is an investment company? We need to understand from Vanguard's perspective. On their prospectus, they're required to say the performance data shown represents past performance, which is not guaranteed for future results. Investment returns and principals will fluctuate, so an investor's share, when sold, may be worth less or more than their original costs. Current performance may be lower or higher than performance data shown. Okay, now this is important because guess where the majority of people's investments are? In their retirement accounts, their 401k plans, their IRAs. Guess where the majority of those funds are in? Those dollars are in mutual funds. Okay, so there's trillions of dollars, and most people don't understand the risk associated with this. I'm not saying that risk is bad, because there's that risk and reward. I'm just saying we need to understand it, the rules and how the game is designed. Okay, this is a financial distributor, investment companies. Now, when we look at Fidelity, they also say before investing, consider the fund's investment objectives, risks, charges, expenses. Contact Fidelity for a prospectus. A prospectus is what we saw here is on the bottom of every single prospectus. A prospectus is a document that they're required to provide to you before or after you purchase a mutual fund that lays out everything. Yes, it's very, very, there's a lot of information. But key here is also on their website, past performance is no guarantee of future results. Okay. Again, I'm not saying that's bad. I'm just saying you need to be aware of it. Why? Because we have to understand certain terminology that the industry now uses, like risk tolerance. You need to understand, since 2008, we started saying, hey, you need to understand how you're tolerant. What are you aware of with risk? Are you okay with losing money, and how much money are you okay losing? Okay. So there's risk tolerance questionnaires to kind of narrow down a little bit what category you're in. Are you the ultra aggressive? Are you a moderate? Are you conservative? Or are you like cash only? I'm scared, right? You're hiding everything, right? So you have to have a balanced portfolio, right? Because that manages risk. You have to be diversified, and you have to allocate your assets. These are all terminologies and ways of looking at investing a portfolio to minimize risk, but it does not eliminate risk. Okay, so that's important to understand. Again, not bad, not good, just letting you know. Okay, what's an insurance company? Well, insurance companies represent safety. An insurance company or insurance is a contract. What's a contract? It's a legal document. In law, contract means a legal document. Okay, so you and the policyholder, the insurance company, the person who's issuing the policy, go into a contract together based on an agreement of what that policy or that contract says. Is it an individual or entity receives a financial protection or reimbursement against loss, reimbursement against losses from an insurance company. Okay, so that policy or that contract says, hey, I'm going to be, if I have an issue and it's going to create financial loss, or I'm going to be reimbursed because of financial loss, the insurance company is going to send me that money. So company pools clients' risks together. So just like with mutual funds where they pool assets together, insurance companies pool risks together. So personal auto. Well, all the premiums for all the personal autos for ABC Insurance Company is all that money is going to be pooled for that risk. Okay. And you make payments to make it more affordable for you. So they spread risk. It's called economies of scale, or the spreading of risk. Okay. Now, insurance policies are used to hedge against the risk of financial losses. That's what we're saying, right? What's hedge? Just to protect yourself, right? To be on the opposite end of it, right? So you can not get auto insurance and go get into an accident, and then you're personally liable for all of the costs associated with your vehicle, their vehicle, liabilities, and any public property damage, right? So that's expensive. So that's what insurance company, this particular auto insurance example, that insurance coverage would assess. The insurance company would say, what's the risks associated with it, what the costs of these associated with, and how much money do we have that we can pool around, and here's the premium that we need to collect. Based on claims on an annual basis, all that stuff, and the cost of fixing vehicles, and you're right, all vehicles are more expensive now because they're all computers, so that increases the cost of insurance. Okay, now both big and small may result in a damage of insured their property or liability of damage or injury caused by a third party. So again, that's the key with the insurance contract. Now here's the key. Everything that works behind the scenes with insurance and that pooling of money is basically capital in surplus. There are capital and surplus requirements. So the National Association of Insurance Commissioners, every state regulates insurance. Okay. Now, before, when we were talking about investment companies, we talked about the SEC, Securities and Exchange Commission. That's a national federal organization. Okay, that covers all states, okay, federally. Now, insurance is managed and controlled by the insurance commissioner for each state. Each state has capital and surplus requirements. Now, the National Association of Insurance Commissioners, it's basically all states get together, the insurance commissioners, and they create rules. Some are very similar that cross state lines. So the very basics of all these rules will be the same for all states, right? But then each state has their own particular flair, so to speak, or things that they may adjust or change based on their particular state, because of population, because of demographics, could be for whatever reason. They have different things that are associated. But the coverages that you pay premium for, that premium and those claims, right? When you have an auto accident, you need to make sure the insurance company has money to pay for that claim. So the insurance companies have to put money in capital and surplus. So the capital is your premium. Okay, your premium is the capital. Now they have to hold the surplus based on that premium. So I'm going to show, let's talk about this. So capital and surplus are essentially the amount of money needed and remaining after insurers and insurance companies' liabilities are subtracted from its assets. Okay, surplus is a financial cushion that protects a company's policyholders in the event of unexpected or catastrophic losses. Remember, what's insurance companies? They represent safety. So where you had capital for a bank, that was a liability. Well, for capital here for an insurance company is an asset. Okay, and so the key here, and here's an example of it. This is the state of California. I just decided to pull that because I'm originally from California, and they tend to be one of the, you could talk to all the insurance companies, they tend to be one of the most difficult states to work with for a whole host of reasons. But let's look at the top line life insurance. They go through in all the different types of coverages as an example, but let's just talk about life insurance. For every 2.25 million in capital, they have to have 100% of capital in surplus. So dollar for dollar, okay? Dollar for dollar, okay? That's the ratio. The ratio is dollar for dollar. Now, why is this important? Because they've got to pay the claims. This is your safety. Now, all three of these financial distributors, it's very important to understand, all three of these could be working in unison with each other. The key and the goal is for you as a business owner to understand these rules, but how do you allow the play by these rules, but how do you allow these different things to work for you, right? You can't be just like real estate investors. All they care about is real estate a lot of times. And so they use banks and leveraging to be able to buy real estate and that sort of stuff. But when you look at banks and what they do, they're one of the number one purchasers of life insurance. Why? Because of safety. So they're leveraging, they want some cash on hand and safety, and so they use insurance policies, cash value life insurance policies to be more specific, to use as an asset to represent part of their balance sheet. Okay, so but insurance companies also use banks to leverage. They also use their own capital to leverage. They also invest in investment companies, right? They also put money in based on the risk of what they're looking to try to accomplish. So if all three of these financial distributors use each other, why doesn't it make sense for us to? Absolutely it does. And so that's the key here, is what I wanted to come across with talking about the financial distributors, is understanding how the rules are played, how they've been changed based on economic situations, but how you and I as business owners can use these effectively to help grow our business, which essentially should equate to growing our wealth and our lifestyle, so to speak, right? Our financial security. And so that's what we want to make sure it comes across. If you have any comments, questions, concerns, go ahead and write those down in the comment section. Any topics you want us to talk about, put those down there as well. If you liked what you heard, please give us a thumbs up. Share this with your other colleagues, your other business owners, your friends at the golf club, or the group that you get together every Saturday morning for coffee, or whatever the case may be. Feel free to share our content with each other. As business owners, we got to stick together. And that's our goal here at Terra Firma Business and Financial Consultants. And as an asset coach and a tax strategist, my goal is to work in unison with you as a business owner, because I am one as well. And so we have the same similar issues that we're addressing. We may have different products and services. Yes, of course, but we need to go through this together. We need to be leaders in our community, and this is a great start for it. So thanks so much. Again, my name is Robert Wolf. I am an asset coach and tax strategist. I am the CEO and founder of Terra Firma Business and Financial Consultants. Have a great day. Thanks so much.